Marketing platform Klaviyo went public on the New York Stock Exchange last week. The IPO priced the company at a roughly $9 billion valuation, but the stock popped 23% at the open before retreating to close up 9%. This was the third largest tech IPO in less than a week. The day before, Instacart went public, and its shares popped 40%. And 5 days before that, chipmaker Arm went public, finishing opening day up 25%. But all three stocks have slumped since their debuts. So, Scott, it seems like we're witnessing a trend here. These companies have a strong pop and then they retreat. What do you make of these results?
This is strange. I've been thinking about this a lot. One,
Yeah.
just disclosure, I got into the oddity IPO, super happy. I'm a baller, aren't I? A genius. Goes from 35 to 55. It's now technically a broken IPO. I think it's trading at, it might even dip below 30 today. But that seems to be what's happening to all these folks is that there's a pop, a bit of a run up, and then sooner rather than later, I mean, shit, oddity's down to 27 and a half. And I'm in it for the long term here, and I like kind of beauty meets AI, so I'm going to hold on. But what it looks like, just from a market dynamic standpoint, is they have a lot of hot money. People are buying the IPO; they're not buying the company. And when they don't see a
Yep.
pop, or they don't see like a lot of upward momentum, or they start to see it getting wobbly, they're out. And typically, the kind of the banker's job is to find sticky money that's in for the long term. And it doesn't appear that that's happening here. It appears that there's a kind of a short-term sugar high. What's also appears, to be kind of true or evident is that valuations have just come down, that the market is saying these might be great companies, but they're not worth the valuation the banks are taking them out at, and that they're recalibrating down. And I think what that means is moving forward is that the IPOs probably won't get the price they had hoped for. I think there's also a dynamic here, and our editor-in-chief, Jason, pointed this out, that the IPO markets are just losing relevance, that the liquidity and valuations companies get in the private markets are now in many ways more appealing than the valuations they get in the public markets. In addition, they don't have the
Yep.
same reporting or administrative costs. So the question then becomes, why go public? And the answer is a lot of companies aren't. The number of IPOs has declined dramatically over the last 20 or 30 years. Fewer companies, I guess from 1980 to 2000, there were 6,500 IPOs. And then from the turn of the millennium to last year, there were fewer than 3,000. So what is that? They're down 60%. And then it used to be a company went public after an average of 6 years. Now it's 11. And the median market value of a company at its IPO adjusted for inflation was 105 million in 1980. And the median value now is 1.3 billion. So it just strikes me that the IPO market, kind of the NYSE and the NASDAQ, are the big losers here, and that it also generates a certain amount of income inequality because the public markets used to be an opportunity for a fireman to participate through his pension fund, and now the private markets are kind of soaking up. In other words, the VCs and other investors say, no, you don't need to go public. We want to capture all of that upside, all of those gains. So stay private longer. We'll give you the valuation you want. We'll give you the liquidity you want. And what was interesting, we were talking about Goldman the other day. Goldman is shedding its consumer business, but doubling down on the secondary business where it's buying or creating a marketplace in pre-IPO company shares. So the question is, are public market stocks in structural decline? And that is, are we going to see, because of mergers, because of companies going out of business, and because of companies waiting longer, or just deciding not to go public, are the public? Do you need the public markets if you can have liquidity and you can have fundraising? Unfortunately, you don't have the same level of transparency. But if you look at the valuations of a lot of these companies, technically, the IPO was a down round. So it's capital has shifted from the public markets to the private markets, and we're seeing what I'd call a structural shift away from the public markets to the private markets.
Do you think that it's also possible, though, that there's an argument to be made that, all of these stocks, yeah, they popped and they came down, but they're now trading at around where they were priced at the IPO? And that could be due to a lot of factors that you mentioned. Also, there's the fact that the float on these IPOs is pretty small. That is the number of shares that are actually sold on the public market. So for Klaviyo, there were 19 million shares, Instacart 22 million. And then you compare that to when Facebook went public and it sold nearly 450 million shares. So the floats are becoming smaller, which leads to heightened sensitivity on trading activity, which creates these exaggerated swings in the stock price. But now they're back to where they were at the IPO. So do you think there's an argument to be made here that they were just, priced correctly?
I don't think so. I think generally speaking, and again, I might be wrong here, but when your stock is back to when it pops and it's back to your IPO,
Right.
the initial price within a week or 2 weeks, I would say that's probably a negative forward-looking indicator. And if they could do it again, you want to. So the bottom line is, a lot of these companies are either near or are broken IPOs,
Yeah.
and it is a branding event. And I mean, it's supposed to be a fundraising event, but it's also a branding event. It sets a tone for the company and the employees and the success of the company. So I think this is basically, and I think the lower floats are a function of they were able to raise so much money in the private markets, and also a lower float creates a mismatch of demand and supply, hoping that the stock gets a pop, right? So every decision, Ed, every decision is made by, quote unquote, the decision makers. The decision makers are a small group of people who only care about the price of the stock. They don't give a shit if this company is harming people. They don't give a shit if they're building a lot of economic security and they have great health plans for their employees. They don't give a shit if they're saving the whales. They want to just know what series of decisions will get the share price up exactly long enough until I plan to sell and then go hang out in East Hampton and upgrade from, an eighth of a share to a quarter share with FlexJet. And so what do they do if they don't need the capital? They take a small number of shares out and hope that they have 12 to 15 times oversubscribed when they go public and that the stock pops. And the stock price is a signal. I mean, these head fake valuations, Instacart was valued at 40 billion at one point in the private markets. And some of that sometimes is a head fake going into an IPO saying, oh, smart people think it's worth 40 billion. So you dumb shit investor on the retail side should buy it at 50 billion.
But by the way, all those late stage investors basically lost money on this. I mean, if you invested like after the A, you're underwater.
Yeah, I think that's right. And then,
yeah,
I mean, let's look at a couple of the companies. So Klaviyo to me, and again, armchair marketing here or pulse marketing, but sort of a level of intelligence and data on top of email and text-based marketing, that feels like a winner. AI and messaging or email growth markets, right? Oddity, granted, I'm a shareholder, so I have a bias here, but I think AI and beauty, that feels chocolate and peanut butter, champagne and cocaine. I look at Instacart, grocery, and media. It's essentially a media company. A third of the revenues come from selling ads on the site. I bet the majority of their profits, if not 110% of their profits, come from the media side. So you have media and you have grocery delivery, and 40% of their transaction volume comes from just 3 grocers where they're Instacarting or whatever those folks are called. To me, this thing just feels vulnerable and in a shitty business and trading at a much greater multiple than a Kroger's, who could kind of come in and make life very difficult for them or underprice them. And Amazon might get very aggressive with them. I think that Instacart, I wouldn't want to get near that thing, even though it's kind of trading where it is. And then ARM is semiconductors. Who doesn't love that? I just think the valuation was kind of crazy. The valuation sort of implies, as does NVIDIA, quite frankly, that they're going to sell the majority of the chips in phones and in AI, respectively. So it all has to be set against valuation. But the IPO market, this has been, it's a couple of things. The IPO market is, I think you'd have to say it's thawing, right? They've already raised more money than they did in 2022, where they raised almost no money. Or I think IPOs are up year to date versus 2022, which is literally a nuclear winter. But it's not, the IPO market doesn't have the momentum we thought it had 1 or 2 weeks ago, because these are good companies. Instacart, I think, has been profitable. It's scaling well. All the numbers are headed in the right direction. But at the end of the day, it's in the grocery business and the media business, which are both, kind of difficult / shitty businesses. And so, and these things they feel like they were priced. They feel like they were priced for the existing investors to get out at a good price
Hmm.
And I wouldn't be surprised if we find out a lot of insiders. Well, I guess we'll know if they're insiders. But you got to
After the
imagine if these
lockup
folks
period.
were in
Yeah.
Instacart for years and years and years, and you're down 75% at whoever the late stage investors are, that you're probably, your legs aren't that fresh. You're probably kind of ready to sell and move on. And I think
Hmm.
that's what we're seeing.
Yeah.
But yeah,
You,
it's
yeah.
no doubt about it. The market isn't holding up for IPOs the way we'd hoped.
I just want to heap some praise onto Klaviyo before we move on. I mean, you
Yes.
mentioned, we're seeing kind of broken IPOs all over the place. 4 and 5 IPOs are not profitable when they go public.
Hmm.
But in the first half of the year, the company hit $15 million in profit. They achieved GAAP profitability before they went public, and they turned that into a $600 million business. So, they're extremely capital efficient. And I just think that's a great business, and we should give credit where it's due. The only bad spots with Klaviyo is one, it's very highly dependent on another e-commerce company, which is Spotify. Around 80% of their revenue comes from customers who use Shopify. And their Shopify contract expires in 2029. So they're a little overexposed on that front.
Hmm.
And then what I would call the ugly side of this, which I think you'll agree with, is the shareholder structure. So the CEO, Andrew Bielecki,
Hmm.
owns 38% of the company,
Hmm.
which is just unheard of in Silicon Valley tech startups. In addition, there's a dual class shareholder structure. So the founders have 10-1 voting power, and they have a majority of the voting power as a result. So there's a risk that they have too much control over the company. And if this is a buy, then you basically need to have extremely high conviction that, these founders are good operators, and they're not going to become drunk on their power. I assume you may have thoughts on that.
We said a lot there, but so first off, let's agree that Klaviyo is an amazing company. Everything has to be set against one thing, and that thing is valuation. Let's assume they do 50 million in profits this year. Let's give them the benefit of the doubt. My understanding is it went out at a valuation of approximately 9 billion.
Yep.
So that kind of translates to a price earnings multiple of 180, which means the growth is going to have to be pretty exceptional here to grow into the PE of an industry that probably is somewhere between 15 and 25.
Yeah.
And I think the market's just going, this is an amazing company that's probably worth 5 or 7 billion,
They're
right?
rewarding them for being good.
There you go. So,
Yeah.
and the same thing with ARM. My understanding is in like has processors in like 92% of phones. I mean, God, that's a rock and roll business, right?
Mhm.
But the market says, okay, even with that gangster business strategy, it's just not worth what they're trying to charge for it. And fundamentals always rear their ugly head. That's the bottom line. And
Yeah.
then around dual class shareholder structure, I love that you're thinking about corporate governance. I think corporate governance is important. I hate dual class shareholder companies. They drive me insane because I think accountability should be linked to ownership. And the reality is these folks have absolutely no accountability. I mean, the Sulzbergers of the New York Times, I think, own 2% of the company and they control it. That makes no fucking sense. That's going to lead to a series of irrational, non-shareholder driven decisions. So dual class shareholder companies are like, you know what? I want to have greater authority than my ownership. They're just inherently, and by the way, the quick history of dual class shareholder companies, they're originally from newspaper companies because like we don't want to be subject to the influences of outsiders who could come in and say, I hate the New York Times, I'm the Koch brothers, let's just go spend $2 billion on 51% of it and then turn it into a Fox newspaper, right? That was the initial argument. Sort of true. And then Google decided they were going to be dual class. And they'd never seen it at a tech company before. And now all these tech companies do it. And to talk the other side, though, the majority of analysis done by financial professors or professors of finance has seen that having a dual class shareholder company has not hurt returns. They have not underperformed the market because typically the only founders that have the
Good.
balls to suggest we're going to be dual class shareholder are in really
Yeah.
hot sectors that are doing really well. So, okay, Facebook or Meta and Alphabet are all dual class shareholder. And guess what? They've performed really well. All the luxury guys, the LVMH guys, the Richemonts are all dual class shareholder companies. And guess what? They've performed really well. So I can't stand the governance. I think it's terrible. If it were up to me, you couldn't go public with a dual class shareholder structure. I think it creates all sorts of problems. But the reality is, from a shareholder standpoint, they haven't underperformed the market.
Yeah. We should get like a corporate governance professor to come on and just talk pure dual class shareholder structure. It's such an interesting topic.